My name is Paul Niven. I am Head of Multi-Asset Investment at Columbia Threadneedle Investments. I'm also the fund manager of F&C Investment Trust, and I've been the fund manager of F&C since July 2014. F&C is a closed-ended investment trust. It's listed on the London Stock Exchange, member of the FTSE 100, and we are focused on growth assets. Our long-term objective is to deliver growth in both capital and income for shareholders, and we seek to deliver that by investing in a diversified portfolio of listed equity and private equity with the use of gearing. In terms of our pedigree and history, we have a history that extends over 150 years. We've got a very long track record of delivering dividends to shareholders. In fact, we paid a dividend every single year since we listed in 1868 and have paid 52 years thus far of annual rises to shareholders. F&C Investment Trust holds a range of strategies in their listed equity portfolio. For example, we've got a European equity strategy with 40 stocks. We have a global income strategy with 70 stocks. And we look to blend these strategies through a diversified approach to add returns while reducing risk for shareholders. When we look at overall exposure in the portfolio, around 60% is held in regionally focused strategies like emerging markets or Europe, around 28% in global strategies, and the balance, excluding cash and short-dated fixed income, is in unlisted private equity. When one thinks geographically, within our listed equity portfolio, we have around about 60% of our exposure in US equities, and the next largest area is Europe with 13% exposure. And if you were to look at our list of top holdings, outside of private equity, we have some familiar names in our largest holdings, such as Microsoft, Amazon, Alphabet, and Nvidia. Over 2023, we raised gearing and reduced cash. We started the period with around 7.3% when one takes gearing with debt at par, and ended the year with gearing levels of around about 10%. Start of the year, around £300 million in liquidity, cash, short-dated bonds, and that was run down through the year, which essentially explains that rise in gearing over the period. And that was obviously helpful in an environment where listed equity markets performed strongly. We came into 2023 with an overweight position on US large cap value stocks. That is a position that had worked well for us in the prior year. If you remember, 2022 was a year when large cap growth stocks like Meta, Amazon, and so on performed very poorly. They lost substantial value against cheaper value stocks. We had been long those value stocks relative to growth. Came into that 2023 with that position on, but we made the decision in the early part of last year essentially to level up that exposure given the outperformance we'd seen from value. So we leveled up growth value in terms of that large cap space in the US in particular. We also changed the portfolio manager who looks after our large cap growth stocks. That was T. Rowe Price, a long-standing manager who we had on the portfolio, and we replaced them with JP Morgan, who now manage that component of the portfolio for us. In the latter part of the year, we also introduced a global focus strategy into the portfolio, which invests in high quality growth companies, and that is run by my colleagues in Columbia Threadneedle Investments, David Dudding and Alex Lee. 2022 saw us deliver the strongest returns amongst our peers in terms of the global equity investment trust universe, but it was a pretty challenging year for markets, and in fact we lost a modest amount of value for shareholders. So it was a good relative return, but not a great absolute outcome for shareholders. 2023, by contrast, saw us deliver a return of around 8% in shareholder total return terms, so a much better absolute return last year, but we did lag returns from global comparators. So global equity markets actually delivered a return of around about 15% last year. So we were some way behind that. And part of that lag in performance is explained by the widening in our discount. We started the year with a discount of around about 3%. And in common with many other investment trusts, we saw a widening over the year, and that detracted from shareholder total return. In terms of our underlying portfolio performance, we did lag slightly that return from global equity markets as well. And there's two primary reasons for that. One, our exposure to private equity was a drag. Private equity has been an area of, historically, in the long run, of excess returns for us. Historically, we have delivered excess returns against listed comparators. That was not the case in 2023. So having 12, 13% of the portfolio in assets which were broadly flat, maybe slightly down on the year, that was a drag against strong equity markets and was detrimental to relative returns. The other primary contributor to us lagging global equity returns was our underexposure to the Magnificent Seven. Magnificent Seven, as they became known, included names like Amazon, Apple, Meta, and so on. And that group of mega cap stocks produced a return of around 70% last year. We had some underexposure to some of those names, just a small underexposure to names which delivered such exceptional returns led to underperformance in our equity strategies overall. So two holdings that I would highlight on the portfolio, not necessarily the largest holdings that we have, but both European stocks. One is Novo Nordisk, which is a Danish-listed company, and the other is Smurfit Kappa. Now, Novo Nordisk had an extremely strong year in 2023. It returned something in the order of 50%. It's the largest company in the world which is focused on dealing with diabetes from a clinical perspective. And they have been at the forefront of drug development, not uniquely, but into new generation drugs to deal with diabetes, GLP-1s as they are known. They have an additional benefit, and clearly related benefit, of assisting with weight loss. This company is extremely well governed. It was set up by two individuals who were instrumental in terms of the early manufacture of insulin, and is controlled by the Novo Nordisk Foundation, which essentially means that they have the benefit of a very long-term perspective and strong governance. And they've benefited from clear growth in demand for key drugs that they supply in terms of dealing with diabetes. There's been continual upgrades in terms of sales and profit projections over recent quarters. We expect that will continue, and they're struggling to meet demand for these drugs, which have been proven in clinical trials to be effective in dealing with diabetes. It's not a cheap stock, trading on more than 30 times this year's earnings, so in no way cheap, and has performed very well. But nonetheless, we retain interest clearly in that. I think there's a strong pathway to growth ahead. Somewhat contrasting that, Smurfit Kappa is Europe's largest manufacturer of recycled paper products. It's also got 25% of its business, which is focused on Latin America, which is faster growing engine as part of the corporate. It did not have a particularly good period of performance in 2023. It lost value modestly, and it's trading in relatively low multiple, around about 11 times this year's earning. There's been some skepticism with a deal which they are undertaking with respect to consolidating with the second largest equivalent manufacturer in the US, where the market is slower growing, less penetration. But we think that the market is going to come round and is beginning to come round to see the benefits of that deal in terms of scale and growth opportunities on a forward-looking basis. So 2023 was a year, I think, of surprisingly strong returns from global equities. We came into the year with concern that there would be a recession in the US, and that recession may lead to material downgrades in terms of corporate earnings. We were facing an environment where central banks were hiking interest rates aggressively, where inflation was problematic. And subsequently, what we saw, and which led in part to strong equity markets, was an avoidance of recession. The growth outturn was better than I think we and many others had feared. A steady decline in inflation rates. And as we progressed through 2023, a greater sense that central banks would be done in 2024 with rate rises and indeed would be looking to cut interest rates. So as it stands now, the picture is, I think, somewhat brighter from a fundamental perspective for equity investment, in the sense that it does look that the previously unlikely, I think, scenario of a soft landing in the US, i.e. recession being avoided, is likely to unfold. We've seen inflation fall at a steady pace and will continue to fall from here. Central banks, including the US Federal Reserve, signaling that they will be cutting interest rates as we move through coming quarters. And growth looks like it will remain reasonable, albeit slower than we enjoyed last year. So soft landing, and an environment where interest rates come down to the extent that we anticipate, while recession is avoided, tends to be a reasonably constructive one for global equity markets, at least historically. One issue clearly is that the markets have moved a long way. Earnings didn't really produce much by way of a gain last year, and therefore much of the improvement in return from global equity markets was about re-rating, people paying more for stock. So a lot is already in the price in terms of expectations, but the fundamental backdrop is improved. That said, beside the valuation point, narrow markets, highly valued technology stocks, there are risks clearly with respect to politics. US elections in November, probably a similar timing in terms of the UK as well, and geopolitics with conflict clearly ongoing in Ukraine and now in the Middle East. So not without risks, but the fundamental backdrop, I think, is looking better for 2024. Thanks for watching. To find out more about F&C Investment Trust, go to our website or click on the link in the description.